Hello everyone, this is Kritika, Assistant Professor, Department of Economics, St.Joseph College of Arts and Science. So in this chapter we will see the theories of profit. Today I will explain in the business economics, the subject code is 21 AECM22. So we will see the what is the theories of profit. First, what is mean by profit? So profit is income received by the organizer or entrepreneur. The entrepreneur is one who organize land, labor and capital to help the producer goods and services to receive her services or him or her his services. This reward is known as profit. Next, there are two classification of gross profit and net profit. So gross profit is surplus of total expenditure of the firm. In the accounting sense, profit equal to the formula of gross profit is TR minus TC. TR equal to total revenue, TC minus total revenue. When we have to minus the total, what we will get the total revenue, we have to minus the total cost, then we will get the gross profit. So next one is net profit. Net profit is the reward earned by entrepreneur for his function. So the income from risk taking or bargaining power or efficiency of the organization of business or innovation is included in the firm. It is also called a net profit. So net profit is reward earned by the entrepreneur, his function, his or her function. So it is a profit. So in economic terms, different authors give different theories of profit. So first one, Clark dynamic theory of profit. Second one, Schumpeter innovation theory of profit. Third one, Hawley's risk theory of profit. Fourth one, Knight uncertainty bearing theory of profit. Next, let's see one by one. The first one is Clark dynamic theory of profit. So J.B. Clark has given the profit theory called a dynamic theory. So who give this dynamic theory is J.B. Clark. So what is mean by dynamic? Dynamic means changing. In the changing the every business conditions or every country situations. So in the dynamic theory means what kind of changes is we included in the business. According to him, profit arises as a dynamic surplus. So dynamic surplus means we have get the extra amount of profit. So it is called a surplus. According to this theory, under the static conditions in a stationary state. So according to this theory, told there is no change in demand and supply in the static state. So in the static state, profit don't arise. The profit is there is no chance to increase the amount of profit because the static state all the condition are same, the situation demand and supply are same level. But in the dynamic state all the demand and supply will changing. Under static conditions, payment made to the factors of production. The factors of production means land, labor, capital and organization. So profit arises only when selling of prices of goods exceed the cost of production. When we will get profit means the cost of production is more than the selling of the goods and products. So then we will able to get a profit. According to Clark, there is 5 dynamic changes in the economy. So first important one is change in quantity and the quality of human wants. So human wants in the sense demand and supply. It will quantity and also quality. Quantity means how much we needed. Quality means how the quality of the products. We need change in the quality and quantity of human wants. It will increase the income of business. Second one is change in methods or techniques of productions. Change in methods or techniques of production in the sense we have to include new methods in the production, then we will be able to get a more profit. Third one is change in the amount of capital. So capital means we have to invest in the business. We have to invest huge amount. We will return get to huge profit. So next one, change in the form of business organization. So change in the form of business organization, we have to build a infrastructure or internal infrastructure or external infrastructure, buildings, equipments. So in this we have to organize in the new technology, so it will increase the profit. Last one, change in population. So change in population, it's a depend upon not depend upon the in the business, it will the our depends upon our whole people activities or whole national. Next one is criticism. In this theory, the function of the entrepreneur is not give any importance. According to this theory, the static state organization will not earn any profit. This is been criticized by the Marshall and gave a new concept called a normal profit, which is earned by a static state. So Clark interpretation of the true only in the case of temporary profit. So next one, in practice is very difficult to measure the dynamic changes in the whole economy. So many economists criticize that the theory has created an artificial and unnecessary difference between profit and wages of management. So finally we have to conclude, there are many criticisms. The theory remains importance to give them dynamic aspect of the profits. What are the dynamic we will give in the business, then how to we will get a more profit. So it is the way of Clark dynamic theory of profit. Second one is Schumpeter innovation theory of profit. Innovation in the sense we have to innovatively include in the any upgraded machines or equipments in business. Innovation theory of profit was given by Schumpeter. According to Schumpeter, profit is rewarded for innovations in the productive process. We have to introduce a new product, so or buy one get one free. So it is a we have to include many more innovations ideas. It will reduce the costs of the production. We have to include upgraded machineries and tools. It will reduce the cost of production and increase the goods and services of the commodity. So this creates the gap between the existing price and the new price of the commodity. So according to Schumpeter, they will give many points what is called a innovations. So introduction of new plant, we have to introduce a new branches or new plants in the our brands. Second one is introduction of new technique in the production process. In previous 10 years we have to use same production process, there is no difference between the profit, there is no chances to increase the profit. In the manager, in the entrepreneur, we have to introduce many more techniques to attract the people, so it will get a more profit. Introduction of new technique. Next one, change in internal structure of the organization. We have to change the equipments, machineries, so it is called a internal structure of organization. Next one is change in the quality of raw materials. So as an entrepreneur we have to check the raw materials are qualified raw materials, only we will get the finished goods or a quality or qualified finished goods. So it is a very important concept. Next one, the form of energy, we have to use energy consumption, it's a very important. Next one, better method of salesmanship. So better method of salesmanship is also called we have to give a free delivery. So first order we have to, there is no charges, so it is called a innovative way to increase the profit. It is the Schumpeter concepts of innovation theory. Next one is criticism of Schumpeter innovation theory. Innovation is only one of the function of the entrepreneur and not the only one function. So it is the part, it is the only one part in innovation. So it is criticized many more economists. Schumpeter innovation theory does not give importance to risk and uncertainty. So we have to include innovative things. We have to face a many more risk and uncertainty. We are losing the profit. So there is no give any importance to the Schumpeter innovation theory in risk and uncertainty. Profit earned by monopoly is permanent, but Schumpeter explained profit is temporary. So in the monopoly situation, there is only one seller. They are determining the profit. So in the there is any clearly explanation in the monopoly market structure. So next third one is Hawley's risk theory. Hawley risk theory. Risk theory of profit was given by American economist Professor Hawley. According to him, profit arises because of the entrepreneur undertake the risk of the business. So here risk means we have to invest amount is huge. We have to invest a huge amount. So risk means we have to get profit or losing the profit, or we have the facing the losses. So it is in the economic terms, risk means uncertainty or losing the profit. So if the entrepreneur is not rewarded, he will not to be prepared to undertake risk. According to this theory, higher the risk, greater the possibility of profit. So the entrepreneur is ready to take any kind of risk and face the problem to increase the organization's income. Entrepreneur is the most important factors in the modern of production. So in the theory of risk theory's criticism, there is no relationship between risk and profit, because profit is not influenced by risk alone. There is it's a one of the only one part. So in the risk is not affected the profit, it will affected but not that much affected. So it is a only one part. So there is many economics says profit is the rewarded of the entrepreneur, not the ability of risk taking but as risk avoidance. So it's a one entrepreneur ready to take risk or not, there is no chance to avoid a risk. According to Professor Knight, insurable risk or risk, but only uninsurable risk or real risk. So insurable risk or not risk. So according to Knight's uncertainty theory, we have to see next one. So we have to clearly see what is the Knight's uncertainty theory of profit. Knight uncertainty bearing theory. According to Knight, uncertainty bearing leads to profit. Knight classified in the terms of there are two classification: forcible risk and unforceable risk. So unforceable risk is called uncertainty bearing. If risk can be insured, it does not risk at all. So we have to insurance our institutions or our business organ, our business or our own shops. We have to insurance. For example, there is many problem in the fire accident or many in the natural problems or risk in the business which can be insured, and losses arising out of this will be given the insurance company. If we have to insurance, the losses amount the insurance company will they help to they will paid. The premium paid for the insurance company is included in the cost of production. Insurable risk does not give risk to the profit. So according to Professor Knight, profit is due to non-insurable risk. So in the economics, non-insurable risk are competitive risk, technical risk, risk of government intervention, risk arising out of business cycle. So in the competitive risk means we have to face many more competition in the modern world. So in the competition we have to face many problems. So it is called a competitive risk. There is no way to insurance in the competitive risk. Technical risk. So we have to every year we have to update or include a new techniques. So we have to face many more problems. Next one is risk of government intervention. Risk of government intervention in the sense, So in the government included in the business, they are decide the price, so then we will get a loss because the government fix the price. It's a permanent risk arising out of business cycle. So in the business cycle, boom, recession, we have to know in the situation we have to face many more problems. So it is uninsurable or non-insurable risk. So criticism of Knight's uncertainty theory. Uncertainty and profits are not explained in the clearly in this theory. There are not explained the profit which arises in the uncertainty bearing. Uncertainty bearing is one of the determinant of profit, not only one determinant. So in this theory, original profit earned due to the business ability, it's not giving the any importance. Uncertainty cannot be measured in the qualitative terms of calculate profit. The theory does not explain in the monopoly profit also. So it is all the theories of profit in the economist give. Thanking you.